480-774-8200, the number to call to join the conversation. We're now joined by Ryan in Phoenix. Ryan, thanks for calling Here and Now. You're on the air.
Yes, hello. I was wondering, after having recently purchased a home, how will this current mortgage situation affect my going out and getting either a home equity loan or line of credit?
Professor, any comment on that?
Well, I would say that in part it depends on your credit score and income. If you have a very high FICO score, you'll probably do pretty well. If you have a steady income stream as opposed to a not reported income stream, you probably will be able to do it. However, the time, I understand, is growing in between your application point and actually receiving the funds, whereas before it was, the DITEC ads, everything is done snap, snap, snap. Well, that isn't quite that way anymore.
Well, I think some of the institutional investors, in other words, the large banks and savings institutions, they're going to continue to do the home equity lines based on your equity position. Are they going to do 100% nowadays? Probably not. Are they going to do 90%? Probably. So it's going to depend, one, on your credit score, one, do you qualify for it percentage-wise, and two, how much equity do you have in your home?
Professor, how long did it take us to arrive at this? There were some July numbers that were put out that people would have been optimistic about if things hadn't seemingly already collapsed well into August. Were those numbers confusing to the people who were actually involved in it on a day-to-day basis like yourself, or were there projections that indicated new housing starts, resales were already having problems in part because of the subprime situation?
We saw this over a year ago coming. We saw housing prices slowing down. All the major entities like the NAR, et cetera, were forecasting either a slowdown in the market, if not a decline. The one thing that is really kind of horrifying and is not over yet are the sheer number of adjustable rate mortgages or ARMs that both prime, which is people that have very good credit scores, very good income streams, et cetera, and subprime, they all got these ARMs, and they're all due to reset this year and next year. And it's a staggering amount. And unfortunately, some of these ARMs, people don't often read the fine print like the Capital One ad shows you to do. What they don't realize is that even if rates have come down a little bit, the ARMs still reset at a higher payment automatically, particularly if you have teaser rates. So we're going to see. So we saw this coming last year. And so it's no surprise to some of us, but it's pretty surprising consumers.
It is true. The unfortunate part is, if you go back to 04, 05, and 06, if you take those 3 years, there were a numerous amount of 2, 3, and 5-year ARMs that were given. And the majority of the ARMs were interest-only ARMs, whether they were subprime or prime. So as those come due, now these people have to either pay the higher payment, whatever that is, or refinance. The people who did the subprime probably won't be able to refinance because they haven't had enough income stream that has increased. That loan product is now gone, so they're going to have a little bit bigger issue of refinancing. And then it comes to every 2 years or every 3 years, we're going to have a large amount of those coming due. So we have to get through the cycle before it all kind of plays out and evens out.